Think about that question seriously for a moment. What actually happens to your portfolio, your savings, your purchasing power, and the economy around you if silver prices experience a sudden, violent shock tomorrow? Not a gradual repricing over 12 months, not a slow bull market that gives everyone time to position. A shock. The kind of move that rewrites economic assumptions in hours. Have you actually mapped out what that looks like for you as an investor? Do you know which sectors get hit first, which assets get repriced, and where the capital flows when a critical industrial and monetary metal suddenly becomes scarce or prohibitively expensive? And here is the most confrontational version of that question. If a silver shock happened tomorrow, would you be the person who understood it in real time, or the person who figured it out 3 months later when the dust had settled? If you are someone who tracks gold and silver prices daily, who watched silver go from $30 per ounce at the start of 2025 to a record high of over $120 per ounce by January 29th of this year, who felt something fundamental shift in the precious metals market over the past 14 months, then you are exactly the right person for this conversation. Subscribe to this channel right now and hit the bell icon so you never miss a market analysis like this one, because the scenario we are about to walk through could change how you think about risk, positioning, and the systemic role silver actually plays in the global economy. Hit the like button if you want more content that treats you like the serious investor you are. Now let us build this out properly, because a silver shock is not just a price story. It is an economy-wide event with cascading effects that most people, including most investors, have never fully traced through the system. And to understand the shock scenario, you first have to understand where silver actually sits in the global economy. Right now, in February of 2026, because the structural position of this metal is unlike anything it has occupied in modern financial history. Silver started 2025 at approximately $30 per ounce. By December of that year, it had crossed $70, delivering a 147% return in a single calendar year. That made it one of the top performing assets across any class globally in 2025, outpacing gold's 64% gain, outpacing equities, outpacing bonds, outpacing real estate in virtually every major market. Then in the first weeks of 2026, silver continued accelerating. By January 20th of this year, silver had surged over 215% year on year. And on January 29th, it hit an all-time record of $121 per ounce. Then came the correction, sharp and fast, driven by CME Group margin requirement hikes that forced leveraged traders into liquidation cascades. Silver fell toward the mid-$70 range within days. By February 9th and 10th, it had rebounded over 6% back toward $83 per ounce. This is the current market environment you're operating in. High prices, volatile structure, institutional participation at unprecedented levels, and a physical market that is tight in ways the paper market has not fully caught up to. Now here's the scenario. Imagine that tomorrow, one of the following events happens. A major supply disruption hits Mexico, which is the world's largest silver-producing country, accounting for roughly 186 million ounces annually. Or Shanghai's physical silver inventories, which already fell to their lowest level since 2015 and 2025, experience what market analysts at Kitco have described as a potential force majeure event, where exchange stocks are so depleted that delivery obligations cannot be met. Or the Federal Reserve's leadership transition, with Chair Jerome Powell's term expiring in May 2026, produces a successor who signals dovish policy, immediately crushing real yields and unleashing the debasement trade in full. Or a geopolitical shock, an escalation in the US-Iran nuclear talks breakdown, a NATO confrontation over Greenland as Trump has already threatened, a Taiwan Strait incident, triggers a simultaneous safe haven bid into both gold and silver that overwhelms available liquidity. Any one of these events, or any combination of them, could constitute a silver shock. And the reason this matters is not just the price impact. It is the second and third order effects that run through every corner of the modern economy. Let us trace those effects systematically, because this is where most investor thinking stops too early. The first order effect of a silver shock is the obvious one. The price of silver rises sharply in a compressed window. If silver goes from its current level of roughly $83 to $130 or $150 in a matter of weeks, that is not just a number on a chart. That is an immediate input cost shock for every industry that uses silver as a raw material. And the list of industries that use silver as a critical input is longer and more economically central than most investors realized. Solar panel manufacturing uses silver in photovoltaic cells. The IEA project's solar capacity will roughly quadruple between now and 2030. Even with the thrifting trend, where manufacturers are trying to reduce silver content per panel to manage rising costs, the scale of new solar deployment globally means total silver demand from this sector is not going to fall in absolute terms. A sudden price spike to $150 per ounce means the cost of manufacturing a solar panel rises meaningfully. which either gets passed through to energy consumers as higher electricity costs or absorbed by manufacturers as compressed margins, or both. Electric vehicles are the second major industrial vector. EV-related silver demand jumped an estimated 20% in 2025. Each electric vehicle contains significantly more silver than its internal combustion counterpart, embedded in sensors, high-voltage wiring, advanced connectors, power management systems, and battery management hardware. A shock to silver prices that is sudden and sustained does not immediately stop EV production, because manufacturers have supply contracts and inventory buffers. But it begins a process of repricing that flows through to vehicle costs and manufacturer margins within 6 to 18 months. When your cost structure for a critical input rises 50% in a matter of weeks, your profit margin on every unit sold compresses immediately. And that margin compression is felt not just by the automaker, but by every investor holding equity in that automaker, every bondholder depending on free cash flow to service debt, and every pension fund with exposure to the automotive sector. Data centers are the third vector, and this one is still underappreciated in mainstream financial analysis. Every data center built to support the global AI infrastructure build-out uses silver and high-efficiency electrical components, precision contacts, and thermal management systems designed to handle extreme power loads. We are building data centers at a pace the world has never seen before. Microsoft, Amazon, Google, and Meta have collectively committed hundreds of billions of dollars in capital expenditure to AI infrastructure over the next several years. Silver is embedded in that infrastructure at every level. A sudden price shock to silver does not stop that build-out, but it does change the capital cost structure of every data center project currently under development, repricing future cash flows for every technology company dependent on that infrastructure. These are not marginal effects. These are core input cost changes flowing through the largest and most capital-intensive sectors of the modern economy. Now let us move to the second-order effects, because this is where the systemic nature of a silver shock becomes genuinely alarming. When input costs rise sharply across multiple industrial sectors simultaneously, inflation expectations reprice. The Federal Reserve and other central banks are already dealing with inflation that remains above their 2% target. In the US, 1 year ahead, inflation expectations recently fell to 3.1%, but longer-term inflation fears remain deeply embedded. A sudden supply shock in a critical industrial input metal does not just affect the products that use that metal directly. It affects the inflation calculus for the entire goods economy. Central banks watching inflation expectations move higher in response to a silver shock face an impossible choice. Raise rates to contain inflation, which would hurt an already fragile growth environment, or hold rates and allow the inflationary signal to persist, which undermines monetary credibility and potentially unleashes further precious metals buying. That is a policy trap with no clean exit. And here is the monetary dimension that is specific to the current macro environment of early 2026. The uncertainty around Fed leadership following Powell's May 2026 term expiry is already priced into gold and silver to some degree. Markets are aware that the next Fed chair could be more dovish, could be more willing to tolerate above-target inflation, could be more accommodative of government spending needs in an environment where U.S. debt has already crossed 100% of GDP. A silver shock that arrives in this window, before that leadership transition is settled, amplifies every uncertainty in the system. Investors who are already questioning the trajectory of the dollar, already pricing in fiscal imbalances, already watching sovereign debt levels with concern across the US, UK, Japan, and Europe, receive a silver shock as confirmation of their worst fears, rather than as an isolated commodity event. That is, the debasement trade in its most acute form. Ed Yardeni, one of the more respected voices in macro strategy, has explicitly attributed the recent surge in precious metals to concerns about excess stimulative effects of U.S. monetary and fiscal policy. Kevin Thompson, CEO of 9i Capital Group, stated that gold has now broken through its prior inflation-adjusted highs, while silver still lags significantly, needing to move into the $170 to $200 per ounce range to reach its own inflation-adjusted historical high. That means a silver shock that pushes prices toward $130, $150, or $175 is not an irrational speculative event. It is, from a long-term value standpoint, a repricing toward where the metal would be if it simply tracked the inflation-adjusted trajectory it has maintained across previous monetary cycles. Now let us address the supply side in precise terms, because this is the fundamental reason a silver shock is structurally possible in a way it was not a decade ago. Global silver mine output peaked in 2016 at approximately 900 million ounces. By 2025, estimated mine production had fallen to approximately 835 million ounces. Meanwhile, global demand reached an estimated 1.2 billion ounces or more in 2025, creating a structural deficit in the range of 160 to 200 million ounces. 2025 marked the fifth consecutive year of a global silver supply deficit. For the 5-year period from 2021 to 2025, the cumulative deficit has reached approximately 820 million ounces. That is 820 million ounces of demand that was met by drawing down above-ground stockpiles, recycling, and inventory depletion rather than new mine supply. Physical inventories at the Shanghai Gold Exchange fell to their lowest level since 2015 and 2025. Lease rates for silver spiked above 5% in September of 2025, a level seen 5 times that year and well above the near-zero historical norm. When lease rates spike that high, it means the people who hold physical silver are demanding a significant premium to lend it out, which is a direct market signal of genuine scarcity in the physical pipeline. This is not paper market speculation. This is real metal that is not available in the volumes that industry and investment demand requires. Now, approximately 71% of mined silver comes as a byproduct of other mining operations: gold, copper, lead, and zinc mines. That structural fact means you cannot simply turn on more silver production when prices rise. Miners are not digging for silver specifically. They are digging for other metals, and silver comes along for the ride. If copper demand falls due to a global slowdown, copper mines reduce output, and silver byproduct production falls with them, even if silver prices are at record highs. This supply-side rigidity is what makes a silver shock structurally more likely than a shock to a metal with more responsive supply dynamics. And then there is the China dimension. Silver prices crossed $100 per ounce for the first time in history in early 2026. Concerns about supply constraints in China have been a specific catalyst in this recent rally. Peter Krauth at Silverstock Investor has publicly warned that Shanghai shortages could cause what he calls a force majeure price shock, where delivery obligations at the exchange cannot be met due to depleted physical inventory. If a major Chinese exchange is forced to declare force majeure on silver delivery obligations, the signal that sends through global markets is not just about silver. It is about the reliability of commodity exchange infrastructure globally. It is about whether industrial buyers can trust that their supply contracts will be honored. It is about the systemic integrity of the metals markets that sit beneath the technology, energy, and transportation sectors. That kind of confidence shock has effects that go far beyond the silver price itself. Now let us bring this back to the investor level implications, because that is ultimately what matters for how you position your portfolio. Citi has issued a silver price target of $110 for the second half of 2026, citing acute shortage of physical silver available for immediate industrial delivery. Goldman Sachs projects gold reaching $4,900 per ounce by December 2026, and silver typically amplifies gold's moves on a percentage basis. Allegiance, gold strategists have forecast silver in the $100 to $144 per ounce range. Gold Silver's lead analyst has stated he would not be surprised to see silver exceed $175 in 2026. These are not fringe predictions from Silverbugs. These are institutional and research-grade forecasts built on the structural data we have just walked through. And crucially, the asymmetry of outcomes matters more than any individual forecast. At the current price level of approximately $83 per ounce, the potential upside to $150 or $175 represents a 80% to 110% gain. The potential downside, in a scenario where the Fed turns hawkish, industrial demand slows, and the geopolitical environment stabilizes, might be a retracement to $55 or $60, which represents a 27% to 33% decline. That is not a balanced risk distribution. The upside magnitude is roughly 3 times the downside magnitude. That asymmetry is what the phrase risk-adjusted return actually means in practice. It does not mean the upside is guaranteed. It means that when you size your position appropriately for your own risk tolerance, the expected value of participation in the current silver market is positive over a 12 to 24-month time horizon. What does appropriate sizing look like? Conservative precious metals allocations in most institutional frameworks range from 2% to 5% of total portfolio value. Moderate investors building structural inflation hedges often target 5% to 10%. At 5% of a $200,000 investment portfolio, that is a $10,000 silver position. If silver reaches $150 from its current $83 level, that $10,000 position becomes roughly $18,000, an $8,000 gain, without any leverage or complex instruments. If silver corrects to $60, that position becomes approximately $7,200, a $2,800 loss. The math of that asymmetry on a properly sized, non-leveraged position is manageable for most investors with a 2 to 5 year time horizon. The math of holding 0% silver exposure in a portfolio when a silver shock arrives is a different calculation entirely, because in that scenario, your portfolio does not benefit from the appreciation. Your cost of living rises through higher prices in energy, technology, and manufactured goods, and your real purchasing power is eroded from both directions simultaneously. That is the core financial argument for understanding this market seriously, not as speculation, but as risk management. And let us not overlook the equity dimension, because silver mining stocks offer a form of leverage to silver price movements that physical silver itself does not. Larry Leopard of Equity Management Associates made this point precisely when he noted that silver miners have costs to mine an ounce in the range of $20 to $30 per ounce. At a silver price of $83, a mining company with $25 all-in sustaining costs is operating at a 232% profit margin per ounce. If silver reaches $120, that same company's profit margin expands to 380% per ounce. The operating leverage embedded in mining equities means that in a silver shock scenario, well-positioned mining companies can deliver returns that multiply the underlying metal's gains. That is a different risk profile than physical silver, one with operational risks, jurisdictional risks, and management execution risks that are not present in physical holdings, but one that offers significant optionality for investors who understand those risks. The bottom line is this: we are not talking about whether a silver shock is likely or unlikely as a binary question. We are talking about whether the structural conditions for such a shock are present in the market right now, and whether your portfolio is positioned to benefit from or be protected against that scenario. The structural conditions are clearly present. 5 consecutive years of supply deficits totaling 820 million ounces. Physical inventories at decade lows in Shanghai. Industrial demand accelerating from solar, EVs, and AI infrastructure simultaneously. Monetary uncertainty at its highest level in decades due to Fed leadership transitions, sovereign debt concerns, and geopolitical fragmentation. An all-time price record having just been set in January 2026. And a market structure that has demonstrated, in real time, the capacity for violent upside moves as well as violent corrections. The question for every serious investor watching this right now is not whether silver will shock the economy at some point. The question is whether you have thought through what that scenario actually looks like at the systemic level, whether you have sized your exposure to participate in the upside without taking on risk you cannot absorb, and whether your financial framework accounts for the role that a critical industrial and monetary metal plays in the modern economy. Because the investors who get caught off guard by a silver shock are not the ones who saw it coming and waited too long. They are the ones who never understood what silver actually is in the context of 2026's economic architecture, and therefore never had a reason to position for it at all. That is the gap this conversation is meant to close. Now, I want to hear from you. After everything we just walked through, what is your take on the silver shock scenario? Are you holding physical silver, mining equities, or ETFs right now? Do you think the supply deficit data is already priced in, or do you believe the market is still underestimating the structural tightness in physical inventory? What would change your conviction one way or the other? Drop your answers and your questions in the comments below. I read every comment, and I respond to as many as I can. If this analysis helped you think more clearly about silver's role in the current economy, please subscribe to this channel and hit the bell icon so you get every new market analysis as soon as it drops. Hit the like button if this gave you real value, because it helps more serious investors like you find this content and join this conversation. See you in the next one.